Hello everyone, this is Rahul Jakaria from Sharekhan. Welcome back to exciting 3R actionable stock updates. 3R basically means right sector, right quality and right valuation. These are our investment ideas. Today we have an update on Sunpharma. Sunpharma continues to report decent earning growth on account of strong growth in the US, emerging markets and rest of the world. This is also led by strong growth in global specialty revenues, which is rising at a robust pace. The company reported 185 bps year-on-year rise in gross margin to 77%, led by better product mix and raw material cost optimization. Healthy gross margins were offset by higher other expense, thus resulting in 91 bps decline in EBITDA margin at 26.1%. Going forward, the management guided for continuous traction in the prescription business and sustained momentum for specialty drugs. However, its CGMP compliance concerns surrounding halol can act as headwinds to its optimum sales growth potential, and although supply have started from Mohali plant, it will take time to report to come to normalcy. As the company clocks in healthy operating profitability, which is in line with our estimates, we expect Sun to clock healthy sales and earnings CAGR of 10.6% and 15% over FY23 to FY25. The stock trades at 27.7 times FY24 and 23.7 times FY25 estimated EPS. We believe superior profitability and margins enable it to trade at a premium to peers. We maintain our buy rating and price target of Rs 1300 for the stock. Next on radar is Transport Corporation of India. Our analyst maintains a buy on TCI with a revised price target of Rs 960. Rolling forward, SOTP based valuation multiple to September 25 estimated earnings, and considering its steady earning growth trajectory, TCI reported inline revenue and net profitability for FY24, aided by healthy revenue growth in SCM and Seaways along with high PAT growth in Transsystem JV. Operating profit margins lag due to pressure in freight and Seaways. The management has retained 10 to 15% year-on-year revenue and net profit growth guidance, with expected pickup in demand in second half. The company plans 2 new ship addition at a capex of Rs 300 crore, which will be delivered during calendar year 26. Hence, the Seaway business may remain flat till FY26. Next, we cover Hightech Pipes. Our analysts retain positive view on Hightech Pipes with an upside of 30%, rolling forward valuation multiple to September 25 estimated earnings, and considering its strong net earning growth outlook over FY23 to FY26. Consolidated earning performance for Q2 largely remained in line, led by healthy volume growth of 18% year-on-year. Steel prices remain volatile, although demand remained steady during first half. The company conservatively guided for 4.25 to 4.5 lakh ton and 5 lakh ton sales volume for FY24 and FY25 respectively. While EBITDA per ton is targeted at Rs 4,000 per ton in Q4, the 1.2 lakh ton of 1.7 lakh ton LDA pipe project at Sanand remained on track to commission by Q3. The target is to reach 1 million ton capacity by mid-26. For more detailed disclosures and disclaimers, please refer to our research report or contact our nearest branch. Please read the risk disclosure document issued by SEBI and relevant exchanges and terms and conditions on sharekhan.com before investing.
Thank you for watching. To keep up with the latest from Sharekhan, make sure you subscribe to our channel. You can also download the Sharekhan app for all your trading and investing needs. Investment in securities market are subject to market risks. Read all the related documents carefully before investing.